What for you was the big takeaway from the auction, and what does that tell us about the aggression of the central bank to keep liquidity low?
The idea to keep liquidity low, I mean, that was expected. That's according to their contractionary monetary policy. But what was of interest was the fact that it's now clear to the market that rates are going up. So it's looking like it's now an intent of the central bank to take up rates in the money markets and in the fixed income markets as well.
All right, so I'm guessing that you're referring to the OMO auction rate. So yes, what can you tell us about that?
Yes, so at the OMO auction, the amount on offer was about 350 billion across 3 tenors, and what we saw was an increase in the rates on the 182 days bill by about 25 basis points, and on the 321 day bill, yeah, that was the bill on offer, the rate went up by 50 basis points. So this was not what the market was expecting, and that caused a major reaction in the secondary markets. So
all right,
what we saw, yes.
Yeah, I was going to go to that. So tell us about the secondary market and how rates have evolved as a result of that OMO auction.
So what we saw once the news filtered into the market was rates across mostly the long-tenured going up. So we saw a major sell-off on the long-tenured bills that had been previously issued at 13.5% levels. We saw those going up by about 30 basis points to 13.8 levels.
But would you say it's a no-brainer that rates are likely to go up if the central bank will continue to be aggressive with its OMO auctions? Or do you think there's a way they can manage the auctions and still keep rates low? Overall, what's your take on that?
I think it's their intent, like I said earlier, to actually take rates up. So it's not about managing liquidity this time around. I think what they're trying to do is to attract investments, most likely from the foreign markets, and yes, the yields would need to go up for that interest to come, into the market.
Now, that's an interesting point. And so I guess the next question is, by how much more do you think yields need to move higher for foreign investors to really get interested again in the market? As we know, they've really been sitting on the sidelines for a while. We have seen some flows, but certainly not at the levels that we saw, say, a month or two ago.
Yes. So, I mean, Treasury bills have gone as high as 18.5%, even in as far back as maybe a year, before now. So I definitely see rates going back to those levels. I think at those levels we'll see the interest coming into the market. And then on the bond side as well, we're about 15.5% levels now. Maybe another 50 basis points, and we'll see those interests, coming into the market.
All right, that'll be interesting to see. But what about the exchange rate, and how critical do you think that is for us to see those flows come in? Now, we've read reports that the central bank has more or less invested as much as $2 billion over the last month to try and manage the exchange rate by providing liquidity to the FX market. Now, some may argue that that's not very sustainable, but overall, what's your take on how critical it is for the exchange rate to be stable to get the foreign investors back in the market?
Again, I mean, most importantly is the intent, of the government and of the central bank at every point in time. So the central bank has said that they would want to keep rates stable at these levels because they believe that the foreign reserves are at about 10 months of import cover. So yes, if that's the idea, that's, there's nothing the market can really do about that. But what we will see is the rates depreciating. I mean, so as much as they would want to keep, rates stable at this levels, the demand is pushing up this rate, and already in some of the markets, the I&E, even the cash markets, we're seeing these rates already, inching up, and I think there's only so much, that they can do